back to Trading Hard Times and Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver. He's my favorite technical analyst. He's with me almost every week. Whenever we can find some time to squeeze Michael in, I like to do that because he helps me keep sane, frankly. He helps me understand where the markets are and whether I'm on the right side of the markets. Now, having said that, I'm not a trader, so I'm not a day trader. I'm not even a weekly trader. I'm not even a monthly trader. I'm a long-term guy that tries to be on the right side of markets when they're in a secular bull market, or out of those or short those when they're in a secular bear market. So, or maybe something shorter than a secular market, but nonetheless, I like to know whether or not the prospects are good for the side of the market that I'm on, and Michael helps me feel that. He is, in a way, my security blanket. Thanks for joining me again today, Michael.
Great to be here, Jay.
And I should tell my listeners, as I try to do every week, it's olivermsa.com, olivermsa.com, to keep up with Michael's doing, and a little bit. I mean, of course, he's not working for free. Who can these days? Michael's not an extremely wealthy guy who can sit around and just and do good for people. He has to take care of himself and his family and all that. But in any event, Michael, I want to ask you, the equity markets, my goodness, they just don't seem to ever want to go down. I've been a bear for the longest time. And, I'm looking at these screaming equity markets today. It seems like up, I saw the NASDAQ was up almost 2%, S&P's, Dow up big. What's your take?
Well, my take is that I made a few notes to be polite before we talk about the equity markets being strong. S&P's up 1.5% on the year, okay? We're 5 months into the year. It's up 1.5%. NASDAQ 100, blue chip index, is down 3% on the year. Healthcare is down a couple percent. Retail is down 4.5% on the year. What's up on the year, stock-wise? Yeah. GDX, the gold miners, up 65% on the year.
Wow.
XLE, the energy sector ETF, up 10% on the year. XLB, basic materials, commodity-related ETF, up 10% on the year. So I would say, yes, stock market's doing great if it's commodity-related. If not, it's wasting your time. And I think I still argue we're at the top. This is the top. We're going down. We're going down seriously over the next year or so. And they can attempt to hold it up here all they want. Most other competitive developed market indices that are comparable to the S&P, let's say, like the Euro Stoxx 50 index, which is the blue chips of Europe, it's down 22.5% from last year's highs. Hmm. So, when you're talking blue chips and developed market, let's forget the emerging market. Yeah. The stock market is not in good shape. What's in good shape right now are commodity-related assets and stocks related to commodities. Gold is up enormously. We had a buy signal that we advertised in January this year. It was elected in the first week of February when gold traded up to 1140 to 1160. We blew out every single long-term oscillator we had on gold that just said rampant buy, 100% long here. Well, now the market has shot up ultimately to 1300. It has had, I think this is our fourth sell-off, each of which scares late-coming longs. There's either $50 to $70 quality, and I've gotten bored with it. So it's a congestive process, I argue, on gold. Also, it's true with T-bonds, which are also inverse to the S&P for the time being. And I think that once this process is over, then the next leg up will occur. So since the February surge, it's been March, April, May, 3 months plus of congestive activity in gold that goes nowhere. Mm-hmm. Actually, it slightly rises. But so I think people have to stand back and look at that. And I even sent you a couple charts before we came on today of a monthly price chart of the GDX and a monthly price chart of the GLD, which is the bullion ETF. And even on a price chart, looking at monthlies going back years, all of this activity, this churning we're getting for the last month or two, is well out above massive breakout levels that are readily apparent. So I regard it as a tempest in a teapot, the attempt to break gold down.
All right. Well, Michael, let me ask you about this. One technical analyst that I heard talk recently, he put on, just as a price chart, not a momentum chart. I don't know if he uses momentum, but he had a price chart that showed the path of the gold bull market, I guess the last two major ones. I'm talking since 2000. Since 2000, the last couple. And he suggested that at this point in time, we should be ready for a 20 to 22% pullback from the top. And the top, I believe, we've gotten up to around 1,300, right? On the
1306 high trade this month. Yes.
Right. So if you apply that, we're looking at a couple $100, maybe down around 1,100 or so. Do you see the prospects?
No, I don't. I think if they were going to do that, it would have already happened. I think the clock has been burning in the favor of the bears, of the sellers, for the last 3 to 4 months. In other words, gold got overdone in February, like the S&P got overdone on the downside. The S&P correction took it all the way back up where it started. Gold correction didn't. It just spun its wheels. And I also believe in the clock, so to speak, that certain time frames of measurement apply. When I'm looking at monthlies or weeklies and I see an effort by a given market to pull back, it doesn't have an infinite amount of time to prove its case. And I would say right now, looking at the weeklies and the monthlies, I'd say the downside in gold that we've seen recently, which is really more sideways, is getting old. And they really haven't gained any ground, the bears, that is. And it can be taken away in 2 days.
Yeah, I mean, we're looking at something around 1230, I think, today, as what I saw earlier for gold. You don't think there's an awful lot of downside from here, then?
Oh, if I had to pin where I think the best support is, it's around 1180. But I'm not even sure we're going there, and I've expressed that view in my market reports, is that, yes, that's the best long-term momentum support, but I don't think the market has the power to get down there. I think that there's another side to this market. You got to realize it's not the longs who are vulnerable; it's the many would-be longs, gold bulls who are so beaten up psychologically and did a disservice to themselves between 2013 and 2015 that they didn't get long this move. Consequently, they're out of the market, wondering what the heck to do. So who's in the worst position? The guy who's long at 1140 or 1160, as we suggested, or the guy who's not even long at all because he didn't believe in the upside and now suddenly is in a quandary. He wants to buy gold, but he's scared.
Yeah.
Who's in the worst position?
Yeah, good point. Well, I guess if we were to pull back to that 1180 or 1200 level, would be probably a good buying opportunity for people.
I think so. Yeah, I just don't have any real hope that you're going to. I sent out a short-term report on gold today, showing dailies even, and I said, if this thing turns $10, $15, it's over from here.
Well, I just really appreciate your momentum charts. So Michael usually shows a momentum chart along with a price chart and shows the targets based on momentum on the price chart, and it's, I think, very, very helpful to me for sure. I have to ask you about the dollar because, of the inverse relationship, the correlation, the negative correlation of the dollar to gold. What's the dollar and the euro? Because the euro is such a big part of the dollar index, as you point out.
I'm most focused on the euro. You're right in that regard. It's 67%, I think, or 50-60% of the dollar index. So it's the papa. Okay. So as the euro backed off from, if you look at a weekly price chart of the euro futures, you'll see over the last year almost that every time you get a weekly close up around 114.5, they sell it. It's like a crew cut. Unbelievable chart. It's like somebody drew with a crayon.
Yeah.
And recently we're up there. You'll poke out above it intra-week, but you don't seem to close a price action out above there. Momentum, however, of the euro is far more positive looking than is the price chart, which looks like it's capped off. Recently, the euro backed off to 111.5 today. I'm arguing if you ever go back to 114.50 ever again, they're going to blow it right through the roof, and you'll go up above 120. And so I'm watching the euro very carefully, and I look at it and I see a sell-off that also looks aged. I don't think it's got a lot more in it, and all it has to do is turn 2.5, 3 cents, and I think it's out of here.
Yeah. Well, that would correlate, I would imagine, to a declining dollar then, and also could also correlate with the next run up in gold, I would imagine.
I think so.
Yeah. Just one more thing before I let you go. You're looking at Italian bonds. I know you explained to us last week Italian and Spanish bonds look like they could be, nearing a period with a price suppression, of course, or let's say the price manipulation that allows those bonds to, provide yields that are just ridiculously low. Market manipulation, as a believer in markets and the laws of physics, sooner or later that markets can't be held down or tried to be held up beyond what their physical requirements. But you're seeing the Italian bonds as potentially vulnerable. And then talk to us just very briefly about
they're not nearby right now. They're not that close to the breakout, but I'm looking at a yield chart, not a price chart of the bond, so it's an upside-down version. And the yields, as you said, are artificially suppressed to levels that are ridiculous, given the nature of the debt. But when I run momentum studies, long-term momentum studies of the yields, it clearly is a bottoming pattern. It has not yet broken out. So it's the kind of thing that when I see a pot that's ready to boil, I will watch it because it will boil. And it's a matter of when. Gold, for example, last year we were watching it very closely, and finally in February this year it broke through. When it did, whoosh.
Yes.
I think the same thing will happen to Italian bonds and Spanish bonds. But they're not at the breakout point yet. It'll take a minor amount of yield rise to cause them to break out. But it doesn't look like something that's going to happen this week or next.
But it's something
in our
we're watching.
reports, we will cover that.
And extremely important, as you pointed out last week, a lot bigger deal than the Greek bond market. And then that would have to come first, I suppose, before the U.S. T-bonds start to break down.
I agree. Yes, I think that's your next vulnerable market. High yields showed their vulnerability for the last year and a half. I think now it's these protected, unduly priced, in jeopardy bond markets of Europe, particularly Italy and Spain, that you have to focus on now. I think still that the U.S. Treasury market is safe. I think it'll remain safe for a couple more months anyway, and probably will remain inverse to the S&P. That may help keep it safe. But at some point later this year, I'm looking for the T-bonds to start down, yields to go up, and even it to start expressing higher yields to come. But I don't think that's an immediate problem. I think it's a potential that's out there later in the year.
Well, Michael, do you think that, I mean, are you just seeing a sort of a trading range for the T-bonds? Are you seeing the possibility of this mammoth multi-decade-long bull market coming to an end for the U.S. Treasuries?
I think it could come to an end. There is a little box on a T-bond chart. In fact, you can see it on most of the T-bonds or T-note charts, and T-bonds in particular. A little range you've been in for the last 4, 5, 6 months, and it looks like that before you ever go down, and I do think you will, you're going to blow out top of that box first, which may entail a new price high for the T-bonds, therefore a new low in yield for the Treasuries. And I think if that occurs, the reason for it will be simple. It will be a flight to quality out of a market that's just, like the S&P going down or something of that sort. And then that may be the T-bond's last gasp. But it looks to me like the first thing is the fake-out, breakout upside, and then later in the year, the downside break, which is going to be more significant.
Yeah. Well, what I appreciate about you, Michael, and I tell my listeners, is that you definitely have a sound understanding of free market economics. You are an advocate, a strong advocate of capitalism and free markets. And though what you do then is employ tools in a sort of humble way, because I think, if you really understand that the collective wisdom of markets is what's important, it's not what any one person thinks. It's what is the market telling you. And you read those tea leaves as well as anybody, at least from a medium to long-term perspective. I just think you're very, very helpful. But it's also your understanding of the interrelationship of these markets. And you've been doing this for quite a few years. I mean, you have quite an impressive background with major financial institutions that you've been working with. So I really thank you, Michael, for coming on to this show so frequently. You've been a big help to me, and I'm sure to many, many of our listeners. And again, it's OliverMSA.com, OliverMSA.com, if you care to avail yourself to Michael's work and to his subscriptions. Anything else you'd like to add today, Michael?
No, thank you, Jay, for that compliment. I try to earn it.
Well, you do.
We try
you absolutely do.
Be early timers and accurate timers, and timing is more important than later being right.
Yeah, you're right about that. I mean, you can have the right concept and be right, but be years early and be a big loser.
Years early and dead before it happens.
Well, I'm usually early. I'm one of those guys that's early, so that's where I find you're very helpful. So thanks so much, Michael, for being with us again.
Thank you, Jay.